The U.S. auto industry, much like many other industries, has been hit hard by the global economic downturn, and it seems that the car price bubble has burst. However, in addition to the general financial malaise, the auto industry has faced additional challenges unique to this sector. One of the key issues the sector is struggling with is the significant drop in demand for both new and used cars. Leading industry experts are warning of a huge price drop by 2023 when unsold cars start piling up on themselves. So an imminent situation is very real due to the rapid collapse of the industry. If you think this means you will be able to buy a car cheaply this year, then unfortunately, we also have to disappoint you because this will not be the case. In this video, we will tell you why. A major factor contributing to the falling demand for cars is the rising interest rates on car loans. This has made it more expensive for consumers to finance the purchase of a car and has led to a significant drop in sales. This drop in demand has had a knock-on effect across the industry, with manufacturers, dealers, and lenders feeling the impact. Even the electric vehicle market, which had been seen as a bright spot in an otherwise gloomy industry, is not immune to the current crisis. According to Bloomberg, Tesla's prices are now $5,000 cheaper than the average price of a U.S. car. This may seem like good news for consumers, but it is a worrying sign for the industry as a whole. It indicates that the price bubble that had inflated EV prices is starting to burst, and that even the most successful EV manufacturers are not immune to the forces that are driving down prices. In addition to the immediate impact on sales and profits, the decline in demand for cars is also creating a growing inventory problem. Manufacturers and dealers have been left with a surplus of unsold cars, which is creating a major financial burden. In 2023, experts are warning that this inventory problem could result in huge price crashes as manufacturers and dealers are forced to clear their excess stock. To prepare for this eventuality, manufacturers, dealers, and lenders need to take steps to mitigate the impact of the current crisis. One option is to reduce production to match the decline in demand, which would help to prevent a further buildup of unsold inventory. Another option is to focus on increasing demand by investing in marketing and promotional campaigns that highlight the benefits of buying a car in the current climate. Furthermore, the industry needs to start thinking long-term about the future of cars and transportation. The decline in demand for cars is not just a short-term problem caused by economic factors, it is also a reflection of a broader shift in consumer behavior. Many people are choosing to use alternative forms of transportation, such as ride-sharing services and public transportation, instead of owning a car. To remain relevant, the industry needs to adapt to this changing landscape by investing in new technologies and exploring new business models. Despite the recent drop in used car prices, the prospect of new cars becoming super cheap for consumers is unlikely to become a reality anytime soon. Affordability issues are expected to persist for the foreseeable future, and in this article, we will explore why. Experts in the auto industry are predicting that the value of both new and used cars will plummet after 2 years of record-high prices. This is due to several factors, including the global semiconductor chip shortage, rising inflation rates, and the ongoing COVID-19 pandemic. The semiconductor chip shortage has been a significant issue for the auto industry, causing major delays in the production of new cars. This shortage has been exacerbated by the pandemic, which has caused disruptions in supply chains and manufacturing operations worldwide. As a result, the production of new cars has slowed down significantly, leading to a shortage of new vehicles on the market. This shortage has caused prices for new cars to rise, making them even more unaffordable for many consumers. In addition to the semiconductor chip shortage, inflation rates have also played a role in making new cars less affordable. As inflation rates rise, so do the costs of production and raw materials, which are then passed on to consumers in the form of higher prices. This has made it difficult for many consumers to afford new cars, especially those who are already struggling to make ends meet. The ongoing COVID-19 pandemic has also contributed to the affordability issues faced by consumers in the auto industry. With many people still struggling financially due to job losses or reduced incomes, purchasing a new car has become even more of a luxury for many. As a result, demand for new cars has dropped significantly, leading to even higher prices for those who can afford to buy them. While used car prices have seen a recent decline, they are still relatively high compared to previous years. According to the Manheim Price Index, used car prices have dropped by 15% this year, which is the largest year-over-year decline ever recorded. However, the average price of a used car is still over $29,000, which is a significant amount of money for many consumers. Furthermore, the decline in used car prices has not been uniform across all vehicle types. SUVs have seen the biggest price drop of 16.6%, followed by mid-sized cars and luxury cars. However, the prices of some vehicles, such as pickup trucks and sports cars, have actually increased in value. New car prices have experienced some declines, but analysts predict that both new and used car prices will continue to drop throughout most of 2023. This situation is partly due to the increased supply of new cars hitting the market as the production of new vehicles recovers from last year's part shortages, especially for semiconductor chips. The decline in car prices is also affecting the electric vehicle (EV) market. Tesla, for example, is now selling its Model 3 sedan for $4,930 less than the average new vehicle sold in the U.S. This is the cheapest price Tesla has ever had relative to the typical U.S. vehicle. Additionally, the price of Tesla's more expensive Model Y sport utility vehicle has fallen by a staggering $13,000 at the start of the year. Other EV makers, such as Ford, Lucid Group, and Rivian Automotive, are also experiencing significant price drops. General Motors is considering delaying the launch of electric versions of its Chevrolet Blazer and Equinox SUVs as the industry cools down. The increasing supply of new cars is partly responsible for the decline in prices. As the production of new vehicles recovers from last year's part shortages, more cars are entering the market, which is leading to increased competition and lower prices. Additionally, consumers are becoming increasingly price-sensitive due to rising inflation and the ongoing pandemic, which is putting pressure on automakers to lower their prices. The semiconductor chip shortage that has plagued the auto industry is also starting to ease, which is good news for automakers who have been struggling to produce enough vehicles to meet demand. With more chips becoming available, the production of new vehicles is expected to increase, which could lead to even more price declines. While the decline in car prices is good news for consumers who are looking to buy a new car, it is not all positive for the auto industry. Lower prices mean lower profits for automakers, which could lead to job cuts and other cost-cutting measures. Additionally, the decline in car prices could lead to a reduction in the supply of used cars, as more consumers opt to buy new vehicles instead of used ones. This could lead to higher prices for used cars, which could be a challenge for consumers who are looking for affordable transportation options. Executives in the auto industry are sounding the alarm about the impact that double-digit drops of 40%, 50%, and even 60% could have on manufacturers and lenders' bottom lines in 2023. If the fear is realized, automakers and their in-house lending units will likely have to write down the value of lease contracts that assumed vehicles would retain greater value. Affordability issues are expected to persist in the U.S. car market throughout the year as prices continue to decline in both the new and used car sectors. This situation is due to an increased supply of new cars hitting the market as production recovers from last year's part shortages. Even the EV market is experiencing price drops, with Tesla's Model 3 sedan now selling for $4,930 less than the average new vehicle sold in the U.S., and its Model Y sport utility vehicle experiencing a $13,000 price decline. While lower prices may be good news for consumers, they could lead to challenges for the auto industry, including lower profits and potential job cuts. Additionally, the decline in car prices could lead to higher prices for used cars, making it challenging for consumers looking for affordable transportation options. The auto industry is feeling the pressure, and executives are starting to sound the alarm about the potential impact on manufacturers and lenders.